Welcome to this week's market drama. We'll begin with markets. S&P 500 was down, so was NASDAQ. The sell-off in stocks and bonds came in the back of Fitch downgrading the U.S. government credit rating, as well as having some mixed data for jobs and wages. When it comes to earnings, the S&P 500 companies have reported, so far 84% of them have reported. The expectation so far, based on what we've seen, is that earnings will be down 5.2% year over year. This would be the worst decline in one quarter since Q3 of 2020. A lot of this was already baked into the price, but it is worth noting that when you look at companies that have beat estimates on average, even those companies are down 0.5% since they reported. Usually, on average, they're up 1% if they beat, which tells you, maybe the market to a certain degree is now trading on macro right now rather than micro, right, their earnings. When it comes to call it economic data, U.S. employers showed their hiring this summer is starting to slow. U.S. payrolls came in shy of expectations at 187,000 payrolls. Expectations were 200,000. Those figures are down significantly from a year earlier, where the average employment growth, for instance, last year was at about 400,000 per month. On the hourly wages, which is a gauge for inflation, it ran hotter than expected at 4.4% year over year. Expectations were 4.2%. If you recall from prior market dramas, when it comes to macro data, inflation really drives the conversation. So the fact that wages are remaining sticky is not necessarily what bulls for the markets are looking, because it might mean that the Fed will stay at current rates for longer. Next week, we have CPI and PPI data for July, which will give us an indication on inflation in the coming weeks. So that's it for this week. Stay tuned for next week.